At 2:13 a.m., the spreadsheet dies. Then the country follows. GTA houses become collateral, families become cash flow errors, and prosperity, so beautifully marketed in CAD, reveals itself as rented leverage with quartz countertops and a banker's smile. William Lyon Mackenzie King issued the warning: surrender currency and credit, and law becomes theater. In the next 40 minutes, you will watch 10 Canadian lives ignore that rule and get liquidated by trigger rate, power of sale, and the national cult of paper wealth. Toronto, world class, polite, profitable, or so the brochure says. Liam sold detached fantasies for a living, and eventually he inhaled his own advertising. 5 suburban houses, lease payments dressed as status, a watch bought on credit pretending to be success. He mistook appraisal screenshots for sovereignty. In Canada's real estate religion, he was not a man. He was a conversion funnel with perfect teeth. Let's do the maths. Declared income? Respectable? Real leverage? Absurd. Liam used Brampton Loans, the open secret nobody officially knows, to inflate earnings and secure mortgages he could never service honestly. Fraud wrapped in business casual etiquette. Every approval email felt like applause. Every new property felt like proof. But credit is not wealth. It is rented obedience, priced monthly and payable in panic. Liam believed numbers on paper were power, not cash flow, not reserves, not productive assets. Paper. He borrowed against one property to support the next, then called it strategy. He rented basements, refinanced equity, and congratulated himself for making his money work. But money was not working. Debt was breeding. He had not built a portfolio. He had assembled a chain of highly flammable promises. Then the macro shift arrived. Not dramatic, not cinematic, just administrative. The Bank of Canada kept rates high. That was enough. In a nation built on overvalued drywall and cheap variable debt, higher for longer became a death sentence spoken in central bank dialect. Liam refreshed lender portals at midnight. The properties were still there. The tenants were still there. But the mathematics had quietly turned hostile. It's called the trigger rate. Clinical, harmless, Canadian. What it means is this: Liam was paying thousands every month, and not 1 cent was touching principal. The debt began to grow while he was still making payments. Do you see the insult? He wasn't owning homes. He was renting money at premium suburban pricing. His empire had reached the exact interest rate where motion itself became reverse. So Liam did what men do when greed meets embarrassment. He doubled the theater. He pulled capital from Chloe's import business. He stalled Kevin's renovation invoices. He delayed maintenance. He juggled credit cards, private money, bridge debt, and denial. The system rewards this behavior right up until it doesn't. Every lie bought him another week. Every week made the final collapse larger, cleaner, and more profitable for the lender. Canada does not need American drama. It has something colder: power of sale. Faster, cleaner, more corporate. The bank does not debate your feelings for years in court. It seizes, lists, and liquidates. Liam watched his own listings become his execution documents. Houses he once marketed as family sanctuaries were now balance sheet carcasses. Raj was thrown out. The neighborhood kept smiling. The paperwork kept moving. In the end, Liam did not lose to a bad investment. He lost to a national delusion backed by institutional credit and personal vanity. He confused access to debt with access to power. Now 5 houses are gone, the commissions are gone, and his domino has tipped the next life into darkness. Chloe needed his money. He withdrew it to feed interest. The chain has started, and it does not stop. Vancouver, ocean views, ethical branding, imported goods arranged under soft lighting. Chloe sold elegance to affluent households and believed elegance could protect her from arithmetic. Liam had been her largest investor. His money felt stable because the properties behind it looked stable. This is how the trap works in Canada. Wealth appears tasteful first, predatory second. She mistook polished packaging for liquidity and social proof for solvency. Her business was never truly cash rich. It was inventory rich, showroom rich, reputation rich, house rich, cash poor, the great Canadian costume. Liam's capital bridged shipment timing gaps, supplier deposits, and payroll. So when his leveraged paper empire began burning, he yanked the money without warning. One investor withdrawal, one spreadsheet revision, and suddenly an import business with premium optics was revealed to be breathing through a straw. So she did what respectable Canadians are trained to do when business cash flow fails. She mortgaged the house to preserve appearances. HELOC, flexible, efficient, a banking phrase designed to sound like competence. In reality, it was the family home being fed into a furnace, disguised as a financial tool. Chloe told herself this was temporary, strategic, professional. But she wasn't saving the company. She was converting shelter into operating loss. Then the system did what systems do. Freight costs surged. Customers slowed. Carrying costs rose. Interest chewed through margins that barely existed before. Marcus, her supply chain manager, kept trying to optimize a machine that no longer had blood in it. You can't optimize suffocation. You can only time its stages. The office still looked successful. The warehouse still looked full. But every pallet on the floor was now a silent accusation. Banks are at their most ruthless when they are most polite. The letter arrived in clean typography, precise language, and total indifference. Demand, remedy, default. The house was worth millions on paper, yet the cash position was terminal. That is paper wealth, a high-priced address with no ability to survive the month. Chloe discovered the national joke in full. You can own a beautiful prison and still be poor. Power of sale is not theatrical, it is efficient. In Canada, efficiency is often just cruelty wearing office attire. The bank did not need years of courtroom spectacle. It needed recoverable value. That meant her house, her equity, her mythology. The business failed first, but the home paid the real bill. Marcus was fired immediately. Staff vanished by noon. By evening, Chloe was no longer an owner, only an asset being processed. The final insult was aesthetic. Everything still looked premium. The branded packaging, the ocean light, the expensive house. Yet all of it had been hollowed out by credit dependency and timing risk. This is how the illusion survives in Canada. Beauty conceals insolvency. Marcus lost his job because Liam pulled money. Chloe lost her house because she trusted investor theater. The ecosystem remains interconnected, even when nobody admits it publicly. Chloe surrendered control of her cash flow to speculators, lenders, and the momentum of a housing cult. In return, the system gave her premium branding, temporary admiration, and a ruthless eviction route. She thought capital was coming to support enterprise. It came to extract collateral. Now Marcus is unemployed, Sarah will inherit the panic, and the proverb sharpens. When credit rules the nation, the law merely formalizes the ruin. Marcus did everything correctly. Corporate role, good salary, variable rate mortgage, a life calibrated for professional respectability. That is precisely why he was vulnerable. In Canada, the middle class is often just debt wearing a collared shirt. He believed a rising career and a rising housing market would validate one another forever. Instead, each depended on the same fragile credit environment, and both were quietly rotting from the inside. Chloe's collapse became Marcus's unemployment in a single meeting. No scandal, no warning, just restructuring. This is how dominoes fall in polite economies. One investor panics, one business fails, one competent employee becomes disposable. The salary that supported the variable mortgage vanished before lunch. By dinner, he had recalculated the family budget 6 times and discovered the same answer every time. The numbers were not tight. They were impossible. Then came the mortgage, variable rate, peak stress. He had bought into the fantasy that homeownership guaranteed adulthood. Instead, adulthood arrived as a notification. Let's do the maths. Job gone, savings thin, monthly carrying cost at the top of the cycle. The system still expected full performance from a man whose income source had already been amputated. He wasn't missing a payment yet, but the trap had already closed around him. The bank had a solution. Of course it did. Amortization extension. 40 years. 50 years. A phrase so bureaucratic it almost conceals the horror. This was not help. It was the institutional acknowledgement that the original loan could not be honored under normal human timelines. The mortgage would now outlive the borrower's optimism, perhaps even the borrower. Marcus stared at the offer and realized he was being invited to finance his own permanent exhaustion. You earn, you borrow, you age, and the principal barely moves. That is not ownership. That is a subscription to hopelessness. Marcus understood something obscene. He might die before the house was paid off. Canadian aspiration had mutated into intergenerational debt maintenance. The condo was no longer a symbol of progress. It was a legal mechanism for extracting labor over decades. His middle-class identity cracked. Sarah would now have to carry the weight. There is a private humiliation to financial dependence that no bank discloses in its product literature. Marcus could no longer be the primary shield. Sarah's salary in tech would now absorb groceries, utilities, transport, and the swollen mortgage. The household became a stress transfer device. He applied for jobs he was overqualified for. He smiled in interviews. He returned home and refreshed the bank app like a patient, checking a vital sign that kept deteriorating. Selling should have been an escape. It wasn't, because selling into weakness does not erase an overbuilt debt structure. Fees, penalties, accumulated balance, market softness. Suddenly the exit looked as lethal as the trap. The condo that once symbolized responsible adulthood could not deliver a clean release. Marcus finally saw the full cruelty of paper wealth. You can be asset-rich on paper and insolvent in motion. The numbers left no dignified exit. Marcus was not reckless. That is the point. He was collateral damage in a system that turned normal ambition into a delivery channel for bank earnings. Chloe's collapse removed his income. His mortgage turned time against him. Sarah will receive the next blow directly. This is how a nation governed by credit behaves, not with open violence, but with prolonged extraction. Marcus still has a home tonight, and that may be the cruelest part of all. Sarah trusted in visible ascent, promotions, equity, performance reviews, the modern myth of the skilled Canadian professional. She believed a software salary could outrun macro pressure if she stayed productive enough. But no spreadsheet at a tech firm can outcode a housing bubble or a central bank cycle. Marcus's job loss transferred the full household load onto her. Overnight, her paycheck stopped being a career tool and became a barricade against collapse. Let's do the maths. One salary, two adults, utilities, transport, groceries, insurance, and a variable era mortgage, now renewing into a different country. The polite national facade says this is manageable for a successful engineer. The numbers say otherwise. Canada sells the image of affluent technical labor while attaching it to housing costs that devour the very income used to justify them. Sarah was not building wealth. She was underwriting the family's panic.
Then the letter arrived. RBC clean logo, calm typography, monthly payment tripling, not metaphorically, tripling. This is how financial brutality appears in advanced economies, not as shouting, but as revised terms. Sarah read the number 3 times as if repetition might soften it. It didn't. Even selling the home might not clear the balance. That was the real revelation. The house was no longer shelter. It was a negative instrument wearing domestic architecture.
She tried the rational escape. Sell, simplify, reset. But fees, accumulated balance, and weaker pricing suggested something grotesque. The home might not fully pay for itself. In a country obsessed with home ownership, this is the forbidden thought. You can follow every sanctioned life step and still arrive at negative equity. Sarah had protected career capital while ignoring asset fragility. Now the core asset was decaying faster than her labor could replenish the damage. As if the mortgage were not enough, the tech sector darkened. Layoffs rolled through teams with the same sterile tone banks use in default notices. Sarah began hearing the corporate weather shift: budget reviews, headcount discipline, strategic realignment. Her salary, the family's last defensive wall, was now attached to an industry shedding people by spreadsheet logic. The macro was squeezing every side of the household: income risk, debt risk, asset risk, simultaneously. So, the household began triage: cancel subscriptions, sell electronics, delay repairs, reduce food quality, perform the national ritual of private austerity while the public narrative still calls this a safe economy. Sarah's skill set remained valuable in theory, yet theory does not pay a tripled mortgage by month end. She was learning the central Canadian lesson. In an asset bubble, professional dignity is just another consumable. Eventually, you sell that too. The most cruel moment was not the letter, it was the acceptance. Sarah realized that effort could not close the gap. More coding, better performance, longer hours, none of it changes the structure of a mortgage that has been repriced into absurdity. She had trusted invisible, upward mobility over asset defense. Now, the system was demanding visible sacrifices instead. Marcus collapsed first in status. Sarah would collapse next in endurance. That is how respectable debt kills. Sarah did not fail because she lacked talent. She failed because talent cannot negotiate with an economy that has outsourced prosperity to debt expansion. Marcus lost the income. She inherited the liability. Raj, Kevin, Jessica, David. They are all inside the same machine, even if they never meet. Sarah's engineering career could build invisible products for the future. It could not repair the poisoned arithmetic of the present. The chain now drops lower. Raj arrived with the promise sold to millions: work hard, stay grateful, and Canada will reward discipline. Instead, he entered a housing monopoly disguised as a nation. He rented a basement apartment in one of Liam's investment houses, drove for apps, stacked side jobs, and learned quickly that survival here is often measured in exhaustion. The immigrant dream had been repackaged into a labor pipeline, feeding landlords, lenders, and grocery monopolies. Let's do the maths. Day shift, night deliveries, weekend rides, 3 income streams, and still a basement room in an investor-owned house. This is not upward mobility, it is managed depletion. Raj kept going because the alternative was unthinkable. Back home, the story of Canada still glowed. Here, the reality was fluorescent, damp, and expensive. Every tip, every bonus, every kilometer drove one truth deeper into his body. The ladder had already been pulled up. Then came a distinctly Canadian terror. The CRA, gig income, mixed deductions, fragmented receipts. Suddenly, every hustled dollar looked suspicious under audit light. Raj was not a criminal. He was overworked, underslept, and administratively fragile. But systems do not audit innocence. They audit vulnerability. While the wealthy bury complexity under corporations and brokers, the newcomer gets interrogated for survival math. In a debt economy, small people are always easier to inspect. Raj's landlord was not really a landlord. He was a leveraged investor impersonating one. Liam's houses had already hit the trigger rate. Payments were no longer reducing debt. That meant Raj's rent was not buying shelter. It was being thrown into a collapsing interest furnace. He lived beneath the floorboards of someone else's speculation. When the structure above him failed financially, the basement below him became disposable, immediately, brutally, and in winter. Power of sale does not care who sleeps in the basement. It cares what the property can recover. Raj was pushed into the night with bags, blankets, and no institutional shield. This is the immigrant bargain in a speculative economy. You are welcome when you can subsidize the carrying costs, invisible when the asset is seized. Snow, silence, headlights, plastic bins on the curb. Canada still looked orderly. Raj's life no longer did. Homeless for the night, audited by day, still scheduled to work the apps by morning, Raj entered a state of modern administrative terror. No single event was cinematic enough for headlines, yet together they formed a total system failure. Housing insecurity, tax scrutiny, weather exposure, sleep deprivation. This is how wealthy countries break people now. Not with one dramatic collapse, but with synchronized bureaucratic pressure applied to the already exhausted. Raj's mistake was not moral, it was civilizational. He believed the host nation's story about itself, opportunity, stability, mobility. But when a country abandons control of credit to speculation, newcomers do not join prosperity. They subsidize its last stage. Liam's leverage needed tenants. Raj became one. Then the lender seized the house, and his labor was discarded like packaging. The dream did not merely fail. It was designed to consume him cheaply. Raj stands where all speculative economies eventually force someone to stand, outside, in the cold, holding proof that hard work is not a sovereign defense against financial architecture. Liam lost houses. Raj lost shelter. Kevin will lose payment next. The chain continues because every leveraged asset requires hidden people beneath it. A nation that worships real estate ends by treating housing as sacred and the housed as expendable. That is the real obscenity. Kevin rode the Canadian housing machine from the service side. New kitchens, finished basements, investor flips, cosmetic upgrades sold as value creation. Work was constant, cash looked strong, and every rush order seemed to confirm that real estate would feed trades forever. He did not speculate directly on homes. He speculated on the permanence of other people's speculation. That distinction comforts many men in construction, right before it destroys them as well. Liam gave him the dream contract: 5 suburban renovations, quick turnaround, strong resale logic, premium materials. Kevin fronted labor, ordered supplies, extended trust, and kept the job moving. This is how credit contagion spreads beyond banks. One man's leveraged ambition becomes another man's unpaid receivable. Kevin thought he was billing a successful realtor. In reality, he was extending unsecured faith to a collapsing interest structure in a tailored overcoat. At first, the delays felt routine. Next week. Refi closing soon. Just waiting on transfers. Canadian ruin often begins with polite postponement. Then the numbers hardened. More than 150,000 Canadian dollars in materials and labor was hanging in the air. Kevin had already paid suppliers. His crews still wanted wages. His family still had bills. He had mistaken someone else's paper equity for commercial credibility. That mistake is how small operators get harvested. To keep operations alive, Kevin used personal credit cards, then more credit cards, then private limits sourced through Jessica's shadow channels. A grown man with tools, skill, and real labor was now financing a business through consumer debt because a realtor's fantasy had imploded upstream. This is the moral inversion of speculative economies. The productive man borrows expensively to survive, while the unproductive bubble had borrowed cheaply to pretend it was productive. There is a moment in every debt collapse when the numbers stop feeling large and start feeling eternal. Kevin found it on a statement total that exceeded what his household could reasonably generate over years. That was the point of no return, not a metaphor, a diagnosis. The debt had grown beyond the scale of effort. More jobs would not fix it. More hours would not fix it. Time itself had been turned against him. Debt is rarely individual for long. Kevin's wife saw the tension in groceries, sleep, and silence before she ever saw the full statements. Family money began disappearing into compound interest that had nothing to do with family welfare. Liam's default had become dinner table stress in another suburb. That is the hidden geometry of the crisis. One speculative lie at the top becomes ordinary domestic misery lower down, where the cameras almost never look. Eventually, the machine ate his instruments. Tools were sold, equipment was delayed, supplier trust evaporated. For a tradesman, this is more than financial loss. It is identity extraction. The very objects that let him convert labor into value were sacrificed to service interest on debts created by someone else's leverage. Kevin had chased the housing boom without buying a house. It did not matter. The boom still found a way to repossess his life. Kevin's collapse reveals the obscenity at the center of the proverb. A nation can still have hard-working people, skilled people, decent people, and be economically rotten if credit has been surrendered to speculation. Liam borrowed to pretend. Kevin worked to produce. Yet Kevin is the one who ends up selling his tools to pay interest. Jessica is next because she fed this machine directly. The chain is tightening, and now it turns inward. Jessica was not trapped by the machine. She helped operate it. Shadow broker, income fabrication, fast approvals, quiet side limits for desperate clients. She took the moral discount because the commissions were immediate and the demand was endless. Canada's housing bubble needed people like her, fluent in paperwork, ambiguity, and plausible deniability. She called it facilitating dreams. In truth, she was distributing accelerant in a market already soaked in leverage and vanity. She engineered Liam's Brampton Loans and later extended lifeline credit to Kevin when the unpaid invoices began choking him. That is the ecosystem in miniature. The fraud that inflated the bubble also financed the damage created when the bubble cracked. Jessica earned twice on the same sickness, on the ascent and the bleed out. For a while, that looked like sophistication. Really, it was just proximity to systemic decay dressed up as entrepreneurial hustle. Her wealth was loud because it was hollow. Designer bags, better condo, better restaurant photos, better angle, better lighting, better illusion. But status funded by unstable commissions is not wealth. It is costume maintenance. Jessica needed the next file, the next approval, the next private placement to keep the surface intact. Underneath the branding, there was no fortress, only throughput. She had monetized other people's delusions and built her own directly on top of them. Then the defaults began clustering. Liam, Kevin's network, other files, other names. The entire shadow economy that had once looked nimble suddenly looked radioactive. Banks reclaimed commissions, reopened underwriting trails, and reported irregularities upstream. When systems feel threatened, they rediscover morality instantly. Jessica had been useful when deals closed. Now she was a contamination source. The machine that tolerated her methods in expansion would punish them brutally in contraction. Then came the CRA, cold, methodical, and devastatingly patient. Accounts were frozen, transfers stalled, access vanished. Financial panic is different when you work inside money itself. Jessica knew exactly what frozen liquidity meant. The lifestyle stopped instantly, not gradually, instantly. Her marriage, her condo, her status signals, everything depended on accounts remaining in motion. Once frozen, the architecture of her self-image collapsed with breathtaking speed. Wealth had been performance. The stage lights were off. This is the most corporate part of the story. The same institutions that benefited from volume now recoiled in scandal management. Commissions clawed back, files escalated, police financial units informed. Jessica had never controlled the machine. She had merely serviced its dirtier edges. When the public optics changed, she became disposable compliance theater. David, her husband, would discover the truth not through confession, but through shared accounts that suddenly could not breathe. David had managed a supermarket. He thought he understood stress, margins, and inflation. He did not understand that his household had been built partly on falsified credit and shadow commissions. When CRA froze the accounts, the truth arrived in the most humiliating form possible: declined transactions, inaccessible savings, and a marriage forced open by administrative force. Jessica's operational secrecy had now become shared domestic ruin. In debt systems, secrecy is merely deferred disclosure. Jessica fed the usurious machine and believed her cut made her powerful. It didn't. It made her vulnerable to the exact institutions she helped enrich. Frozen accounts, collapsing status, shared assets contaminated. This is what happens when short-term gain substitutes for sovereign control. David will now carry the next phase through consumer debt and shame. The woman who manufactured paper incomes is left staring at a deeper fact. Paper burns fastest. David managed a Loblaws store and still struggled to afford groceries. That is not irony. It is diagnosis. He lived in a $1.8 million house and worried over produce prices in the aisles he supervised daily. This is paper wealth in its purest Canadian form. Asset inflation outside, cash compression inside. He performed upper middle class normality while inflation, consumer debt, and hidden household risk quietly tightened around his throat. Credit maintained the costume. Consumer balances, auto payments, the mortgage, all manageable as long as motion continued. Jessica handled the more mysterious flows, and David accepted the surface. He was trying to preserve a class identity funded partly by borrowing and partly by ignorance. In speculative economies, ignorance can feel merciful until the joint account freezes. Then, every concealed risk becomes marital fact, and every monthly payment arrives stripped of illusion. When CRA froze Jessica's accounts, David's reality split in two. The house remained, the obligations remained, but liquidity disappeared. That is what most people do not understand about collapse. It often arrives not as poverty, but as inaccessible normality. The mortgage still needs paying. The groceries still need buying. The home still needs heat. Yet the account designed to animate domestic life has become static. The house is alive on paper, dead in cash. The humiliation was small enough to be ordinary. Card declined. In his own store, under fluorescent light. Surrounded by food prices, he knew by memory. It is one thing to discuss inflation abstractly. It is another to manage a supermarket while borrowing against identity at home and discovering, in public, that status no longer converts into purchasing power. David had worked to preserve the facade. Now the facade was refusing to approve at checkout. To bridge the gap, he leaned harder on credit. That is the Canadian reflex. Consume the delay, finance the shame, hope for restoration. But rates remain high, balances compound, and every temporary bridge becomes another permanent mouth feeding on monthly income. David's collapse was not spectacular. It was suburban, repeated, quiet, and increasingly mathematical. The kind that never trends online because it looks too much like normal life until the numbers are read honestly. Status anxiety is a tax few discuss openly. David could not easily downsize his habits because the habits themselves were part of how the household signaled success. Better area, better school catchment, better car, better optics. But optics are expensive to maintain when the cash engine underneath has seized. Jessica's hidden world had contaminated the visible one. David was now paying emotionally for prestige he never truly owned in the first place. What happens when a paper-rich life runs out of liquid patience? You begin selling fragments of the costume, electronics, jewelry, extra furniture. David started moving through the house as if inventorying a failed retail floor. Every item had a memory. Every memory now had a market price. This is the final insult of consumer debt. It forces the family home to become a liquidation catalog long before the bank formally arrives. David tried to maintain an upper middle class shell with borrowed money and second-hand certainty. The result was predictable. Once Jessica's shadow finance collapsed, his visible life became unsustainable almost immediately. He is not the architect of the fraud. He is the spouse attached to it by shared debt, shared assets, and shared illusion. Amira supplied the hidden liquidity behind Jessica's machine. Now, the chain moves upward toward the private creditor who thought she was untouchable. Amira believed in micro-hubris, not reckless enough to look foolish, just sophisticated enough to feel superior. She lent privately, bridged cash, and harvested attractive returns from people who needed money faster than institutions could deliver it. Jessica received advances. Chloe received hot money. On paper, this looked elegant, high yield, asset-backed, selective. In reality, Amira had mistaken access to distressed borrowers for control over the macro. She was lending inside a landslide. Private credit thrives where formal systems become too slow or too suspicious. That is why Amira could flourish while the bubble expanded. Jessica needed commission float. Chloe needed emergency business cash. Others needed bridge liquidity to keep appearances alive 1 month longer. Amira told herself she was being opportunistic, not exposed. But every secured note was linked to the same sick environment: real estate inflation, fragile cash flow, and borrowers already late in the cycle. This is the illusion of private creditors. They believe liquidity equals optionality, that they can move faster, seize earlier, survive better. But liquidity is only real until everyone needs it at once. When Jessica's accounts froze and Chloe's house was taken, Amira's expected inflows collapsed from scheduled to imaginary. Her books still looked asset-backed. Her actual cash position began disintegrating. Paper security, cash fragility. The old Canadian joke, now wearing higher heels. Worse, larger funds above her began demanding performance, repayment, and collateral enforcement. This is the reality private lenders often ignore. They too are downstream from stronger predators. Amira had played the creditor in local ecosystems, but globally, she was another leveraged node. When her borrowers stopped paying, her own obligations accelerated. The tower of extraction simply rose above her. She had spent years charging desperation, only to discover she was not high enough in the food chain. The liquidation phase is brutal because it removes even the illusions sophisticated people use to comfort themselves. Diverse assets, legal structure, personal guarantees, secondary collateral. None of it mattered once the network froze and the bigger money called in the claims. Amira had mocked retail investors for being emotional. Now she was learning a colder lesson. Macro shifts do not care how elegantly you documented your exposure. They only care who gets paid first. This was the part the proverb predicts with surgical cruelty. Once usury controls the structure, nobody is really sovereign, not borrower, not broker, not private lender. Amira watched her legitimate assets get stripped to satisfy superior claims: cash, securities, property interests, every legal layer peeled back. She had thought micro-arrogance could outplay macro-violence. It couldn't. The system she fed had finally recognized her as edible. That recognition is always efficient. There is a specific sound to losing everything legitimately on paper. It is not screaming. It is page-turning in a quiet room. Amira's empire did not collapse in public. It collapsed through enforceable documents, the kind with signatures, covenants, and superior claims. She had profited from other people's desperation and called it discipline. Now, her own sophistication offered no emotional shield. The ledger had gone empty. Only the arithmetic remained, exact and humorless. Amira's fall proves the proverb's final cruelty. Once credit governs the nation, the hierarchy of ruin becomes the real constitution. She lent, extracted, and believed herself above ordinary borrowers. She was not. She was another participant inside a structure whose only lasting loyalty is to superior claims. Ethan, the youngest, the newest buyer, will inherit the last stage. Not because he engineered the system, but because systems always reserve their finest traps for the end of the cycle. Ethan was told he was lucky. Prices had cooled. Listings were softer. A power of sale property from Liam's collapse looked like opportunity, proof that patience had finally rewarded the disciplined young buyer. This is how late cycle traps are marketed: as prudence, as value, as a foothold in a broken market. Ethan did not realize he was buying not just a house, but a position inside the same macro machine that had already destroyed 9 lives before him. Like many Gen Z buyers, Ethan stretched to the edge because there was no other way in. Minimal buffer, maximum debt, variable sensitivity hidden under optimism. This is the cruelty of entering a captured market. Youth is converted into leverage because ownership has been priced beyond youth's natural means. He was not greedy in the old sense. He was structurally cornered. The system called that ambition. The balance sheet called it fragility from day one. Then came the part young buyers always underestimate. The macro does not reset because you finally entered. Energy costs tripled. Supply chains remained fractured. Inflation pressure refused to die cleanly. That meant rates stayed high. Ethan had bought the narrative that the bottom had arrived, but bottoms are irrelevant if the policy regime remains hostile to debt-heavy households. He had entered the market at the exact moment the machine was still hungry for fresh blood. And then, with exquisite systemic cruelty, Ethan hit the same trigger rate trap that had destroyed Liam. This is the point of the story. Different age, different intent, same machine. He made payments, watched principal stall, then grow. Imagine being 25 and discovering that your debt is reproducing faster than your labor can attack it. That is not home ownership. That is a youth extraction mechanism encoded as a mortgage product. Gen Z had already been priced out of optimism. Now Ethan watched time itself contract, travel postponed, relationships delayed, children unthinkable, savings non-existent. Every projected milestone of adulthood was being consumed by a mortgage that behaved like a living organism. This is what a captured economy does to the young. It doesn't merely overcharge them. It colonizes their future and bills them monthly for the privilege of remaining behind schedule. The true terror arrived early. Even before formal renewal, Ethan could already see the structure of it. If rates remained elevated, if wages failed to catch up, if costs stayed hostile, then the next letter would be an execution memo disguised as a product update. This is the late-stage Canadian rite of passage, discovering that buying the house was not the victory. It was merely your enrollment into a longer, colder negotiation with mathematics. Ethan is the ultimate collateral because he arrives innocent. No Brampton loan, no shadow commissions, no luxury costume. Just a young buyer trying to enter a nation whose productive economy has been subordinated to asset inflation. That is why his story hurts the most. The system does not merely punish greed, it eventually consumes compliance. By the end of the cycle, even caution is redirected into the trap and sold back as responsible adulthood. And here, the documentary closes its fist. Liam lied, Jessica manipulated, Amira extracted. But Ethan simply entered the market at the end of a long national hallucination. All roads led here. When a country surrenders control of currency and credit, law becomes administration, debt becomes governance, and youth becomes collateral. The house Ethan bought from Power of Sale is not a bargain. It is evidence. The proverb was not rhetoric. It was a map.